The 1991 American economic recession is in many ways a precursor to the more recent 2009 housing crash. Both had a lot to do with real estate, but today we are going to see what we can learn from what came to be known as the savings and loan crisis of the 1990s. Listen, the future of our favorite cryptos has actually been tanking, and reports are saying that there could be further to fall. And I want to know how I can position my portfolio to be recession-proof without having to take heavy losses in the crypto that I am invested in. And I'm not just talking about converting to stables. So this series is an investigation into the darkest periods in American and world economic history to identify what caused the recessions, how the economy eventually recovered, and most importantly, what assets remained resilient. And I'm going to be throwing you some flaming knowledge balls from up here on the pictures mound, so make sure that you think fast. But before we get into the nitty-gritty of this American travesty, make sure that you smash that like button. Make sure you hit subscribe, boom, bang on that notification bell. Comment anything that you want in the relevant sections. I appreciate it. Now, let's go see what we can learn for our future from our past. The 1991 American recession didn't actually break any historical records, but it still qualified as a recession for about 8 months, which lasted from about July 1990 all the way up to March of 1991. High unemployment, slow economic growth, and declining stock prices stunted portfolio growth for millions of Americans who did not react fast enough. So naturally, I wanted to find the lessons from that time that we can actually apply today so that our portfolios thrive during the looming 2023 potential recession. The recession was the result of a number of factors, including the end of the 1980s economic expansion, the savings and loan crisis, and the Gulf War. And the backdrop for the 1991 recession was the end of the 1980s economic expansion, which was a period of strong economic growth and low unemployment after the insanity of the 1982 recession. But as the expansion came to an end, the economy began to slow. And a slowing economy is a fragile economy. Nobody knows if the slowdown is going to lead to something worse or if it's just a temporary or transitionary lapse in growth. But for the most part, investors don't want to miss out on gains, so even in times of slowing growth, they stay invested but become more cautious. At least this is the logic of the professional institutional investor, who is also held accountable by its angry clients if they mess up. Meanwhile, more aggressive money managers and independent investors may see a slowdown as a time to get ahead and gain an unbalanced exposure to the market in anticipation for the eventual upswing. It was fair to say that in the end of July in 1990, there was a growing number of over-leveraged aggressive money managers that ultimately took on more risk than their knowledge and experience could actually handle. Good decision. Add on top of this overexuberance a wave of deregulation in the thrift banking industry from US President Reagan in 1982, and you are left with a savings and loan sector that was attracting a concentration of dumb money managers out for big commissions. This dangerous cocktail of economic ingredients resulted in thousands of over-leveraged small mortgage banks failing and turning to government assistance to get bailed out when the real estate market began to turn bearish. This was the psychological risk dynamic as the late 1980s post-recession recovery was clearly drawing to a close. The stage was set for an economic event that few could have even known was going to happen, and even less were actually prepared for. The Federal Savings and Loan Insurance Corporation, or FSLIC, was originally established by Congress in 1934 to serve as the safety net for the savings and loan industry for cases of emergency liquidations. It was an institution that was positioned to work similarly to how the FDIC works today, except for banks. The FSLIC became extremely strained by thousands of these savings and loans banks failing and needing relief funding that the FSLIC eventually itself became insolvent. Great. And remember, back then the US government had not yet deceived the average American voter into believing that printing trillions of dollars was okay outside of wartime. Nowadays, a crisis like this would have been solved by just printing trillions of dollars and putting a band-aid on the root issue. So instead of flipping on the printers like the Fed loves to do now, Uncle Sam actually used taxpayers' money to attempt to bail out the FSLIC several times. When that did not work, Congress actually gave up on the FSLIC and abolished it. Savings and loans banks could actually no longer file for relief funds, and by 1995, 3,234 savings and loans associations had failed. The lucky ones got bailed out, but many more were actually left holding all the mortgages that were unlikely to get paid off. That economic event was a 1-2 punch to the finance industry and the real estate market, as new home building starts fell to a low not seen since World War II. And that was trouble enough, but it would not be a late 1900s US recession without something going south in the Middle East to spike oil prices. Interstage left, the Gulf War, which took place in 1990 and 1991, and that was also a very bearish factor in the 1991 recession. The wartime period saw oil prices skyrocket by over 166% from June to October of 1990. As before, in the 70s and 80s, these sudden high oil prices spiked inflation and created higher costs for businesses and consumers alike. I will say though that this time around the Fed actually cut rates, and when oil prices quickly came back down, high inflation healed itself. Good job, feds. But that's the story of the 1991 recession. Now, let's get into how the different asset classes performed during this period of havoc. The Dow Jones Industrial Average, a broad-based index of stock prices, fell by 22% from July to October of 1990. Many sectors of the economy were particularly hard hit, including manufacturing, construction, real estate, and retail. Surprise, surprise. There were some assets, however, that performed relatively well during this recession. Government bonds, which are debt securities issued by the government, did relatively well, despite the fact that the Fed cut rates quite aggressively from early 1989 through mid-1994. The demand for bonds this time around was likely because the asset class had outperformed in the previous recession, and the clear American victory in the Gulf War created a renewed confidence in the US government and its currency. The lesson there is that winning wars can absolutely bring demand to your sovereign bonds. Domestic and international investors love to back the winner. The other obvious reason why bonds outperformed real estate was because the savings and loans banks that facilitated a lot of real estate investment had become discredited in the view of the average American investor and financial institution as a whole. Stocks were bearish, real estate was bearish, oil was fantastically bullish, but few investors had practical avenues to benefit financially from the oil prices rising. And obviously bonds were bullish, but how did gold perform? Well, it's hard to say exactly if it were bullish or bearish because it depends on where you bought and sold in the case of gold. The weekly candle closes at the front end of the 8 months from July 1990 to March 1991. You would have only seen a 1.7% appreciation in the investment of your gold, but you didn't lose any money. And then gold spiked and then fell during the recession itself. Weird. If you had rotated out of stocks and into gold in July of 1990 and then sold at gold's price peak in August of 1990, then you would have walked away with a cool 18% gain in just a few months. That's solid. Now, overall, you can still easily say that gold was a way better asset to own during the recession as it preserved capital and purchasing power very well, at least compared to stocks. Would it have been better to rotate into bonds? Technically, during the 1991 recession, the answer is yes, but clearly both gold and bonds were the assets to be in over stocks and real estate. And remember, gold isn't necessarily about making money, it's more about preserving wealth. Based on the recessions we have studied so far in this series, gold is now 3 for 3 as a viable recession-proof investment. Bonds are 2 for 3 while stocks and real estate both remain 0 for 3, unless you're talking about commercial and apartment real estate. Nobody wants to take risks on what-if investments when a recession is on. During periods of expansion, sure, investors see the most gains by far in stocks during non-recessionary economic expansion. But this is because those what-if investments into new business ideas and new residential builds tend to play out more positively in those periods of expansion. Odds are against the what-ifs during recessions because investors are looking for assets that the value of which is already proven and maximally intrinsic, like gold and government-backed bonds. So the 1991 recession was eventually resolved through a combination of fiscal and monetary policy measures. The Fed further cut rates and Congress lowered taxes and increased spending. Over time, these measures helped to bring the economy out of a recession and into a period of sustained growth. The recovery from the 1991 recession was not without its challenges. It was accompanied by high levels of government debt and budget deficits. And 1991 was the first time that the US government got comfortable with the high levels of deficit spending in peacetime. Nevertheless, the measures taken to resolve the recession were ultimately successful in returning the major economic indicators back to healthy levels. Many believe that the savings and loan crisis that we explored today was a glaring hint to economists of what was to come in the 2009 housing crisis. But we will cover that crisis and the recession that ensued in the next and final episode of this series. And if you enjoy content like this, go watch the previous videos and make sure you show up for the finale of the series. And make sure that you smash that like button. Make sure you hit subscribe, boom, bang on that notification bell. Comment anything that you want in the relevant sections. I appreciate it. Thank you so much for showing up to this video. I will see you in the next one. Have a good day, everyone.